Hello, everyone. Welcome back. I am Nicole Payne, CMA, and as always, I am here to drop some accounting truth bombs. Now, today is the first in a mini series that I am going to be doing about financial statements. And if you are a small business owner, more than likely you've either been receiving financial statements or you have been in a position where someone has requested financial statements. So, what are financial statements? In short, they are a packet of reports that tell individuals, you as the business owner, or external people who are looking for information about your business, they tell them, those individuals, about the health of your business. So there are, in a typical packet of financial statements, there are 3 reports. The 3 primary reports are the profit and loss, sometimes referred to as the income statement, the balance sheet, and the statement of cash flows. Now, for smaller businesses, you are most likely running your business on a cash reporting basis. So there isn't usually a statement of cash flows. But if you're a bigger business, you're likely running on an accrual reporting method, and that would be when you would see that statement of cash flows. But more about that in future videos. And if you're wondering what cash basis reporting and accrual basis reporting is, check out my other video that's called Reporting Methods. So let's talk financial reports. Your P&L. Your P&L is essentially profit and loss for a particular period of time. So it tells you everything that you've earned in that period of time, everything that you've spent in terms of cost of goods sold and expenses, and then at the very bottom it tells you whether you made money or lost money during that period. Now, with an accounting software like QuickBooks, you can run that P&L on any amount of time, from 1 day to the entire time that you've been using the accounting software, or any information that you have in there for the life of your business. So a lot of times you'll see that you'll run those reports in comparison view, where you see month over month, or this month of this year compared to this month of last year, or a quarter, or a whole year, and do these comparisons. We'll talk about that when we do the deep dive into how to read the P&L and what it looks like to see those comparisons. But then there's the balance sheet. And the balance sheet is, as you guessed it, another financial statement, but this one is a little different from the P&L in that instead of showing a whole period of time, it shows a snapshot of what you have in your accounts as of a specific period of time. So this is talking about things like your bank accounts, the things that your company owns, what assets the company has, any liabilities the company has, so things like credit cards, accounts that you have with vendors that you owe money to, or loans that the company has taken out to pay for expenses. And then it also has the equity portion, which is where all of the earnings of the company, any investments that the owners have taken or put into the business, any distributions that the owners have taken out of the business, that's all reported on the balance sheet as of a particular day. Then there is the statement of cash flows, because if you are running on an accrual basis with your reporting method, then your profit and loss will tell you that you have X number of dollars of earnings, but that's not necessarily what's going to sit in your cash accounts or in your bank accounts. And that is one of the number one questions we get. So this statement of cash flows tells you what changed on your balance sheet in terms of things that you've purchased or things that you've paid for that aren't on the P&L, marries the two together. And that tells you what has changed, why your cash balance has changed over the same period of time that your P&L says that you should have earned money. So again, we will go into more of a deep dive of these things on future videos. But for now, that's just the basic overview of what financial statements are when you're being asked for them. Out of our office, we also send a few other reports with the financial statements. A couple of them include the Ask Client report, and that's really when we have questions about a transaction. We're not exactly sure what you would have been spending the money on. We will send you that in a report form and say, hey, can you give us some notes on what these things were? We also send out what's called an owner's draw or owner's distribution report. And the more formal term for that is change in ownership equity, but we don't go with formal in this office because, as you know, we just like to keep things a little casual and not so intimidating. But that statement of owner's equity change or the owner's draw, owner's distribution report that we send out, that just tells you any transactions that have come out of the business that were for personal purposes. And the reason we send that is for our clients to take a look at it and say, hey, yeah, you said that this was a personal purchase, but this was definitely business related and this is what I was doing. And it's great because this way we make sure that there's a lot of communication and there's no room for error because there's so many levels of quality control in those reporting functions. So if you have questions about financial reports and specifics about how to read them, what they mean, go ahead and put them in the comments here because as I'm recording these other videos, I want to make sure that I take those questions and comments into consideration. Um, Feel free to shoot me an email. My contact information is at the end of this slide. And as always, I'd really appreciate it if you would like and subscribe and comment on my Facebook, my YouTube, LinkedIn, all of those places where you can find me. I would love to get in touch. We'll talk soon, everybody. Take care.